oil and gas. We're going to need oil and gas for the rest of my life.
Oil and gas sector.
Metallgesellschaft is a German conglomerate company where their main operation is in the metal business. However, in the early 1990s, they decided to open a new subsidiary in the US called Metallgesellschaft Refining and Marketing, in which they began to invest in energy derivative, particularly in the oil and gas segments. They also hired Arthur Benson as their president. Due to these reasons, Metallgesellschaft Refining and Marketing began to be involved in a major cash flow crisis from their derivative strategy. The crisis started with the initial deals made by the MGRM, in which they entered into the short position for their oil forward contracts. The forward contract has a long-term maturity for 10 years. The reason behind the MGRM's decision to engage in this forward contract is because they actually sell its refined products in a physical market where the delivery will be made in a future date. Therefore, they would want to lock the price in the future from rising, because the rise in prices will lead to losses for them who took the short position. However, this position was actually profitable for MGRM because the forward price is always above the spot price, with $5 as their profit margin, and from 1990s to 1993s, MGRM was able to sell 160 million barrels. Nevertheless, for MGRM to hedge the risk in their forward position, they entered into the short-term future contracts, in which they took the long positions. The main aim for them to enter into this futures contract was to mitigate the losses from their forward contract in case the price rises in the future. They believe that with this strategy, MGRM will be able to increase their efficiency in managing their risk. The other reason why they engage in future is also because they already targeted that the oil prices will rise in the future, and because they believe that the market will always be in a backwardation. To manage the spot price risk, MGRM employed the stake and roll strategy for its future contract. Because the futures are only for the short term, they implement this strategy by buying the contract only in nearby delivery months. The stake and roll strategy is when they stake the short date future contract by purchasing it less in future months, and the roll strategy is when they continuously purchase the future until their forward position is fully hedged. The main aim for this strategy is to increase the liquidity and ensure their earnings by buying it on a short term, where they will instantly get the money in 1 month. However, this strategy is only profitable when the market is in a normal backwardation, because the future price will always be lesser than the spot price. However, in 1993, the world experienced a drop in oil prices. This because of the authorities that are unable to agree on the production cuts of the petroleum, which has caused the oversupply of the product in the market. Because of the theory of demand and supply, when the supply exceeded demand, it has led the drop in the oil prices. When this incident happened, the impact was terrible to MGRM.
MGRM company implement a hedging strategy by assuming a long position in short-term future contract. Additionally, the company solely rely on the backwardation trend, which indicate that the future price is lower than spot price. Surprisingly, the oil market underwent an unexpected shift to contango, which stand in stark contrast to backwardation, and this trend persisted throughout the entire year. Consequently, the company incurred losses amounting to a staggering $1.8 billion due to their long position, prompting the question of whether MGRM company was engaging in hedging or speculating. By observing their long position in future contracts, it became evident that the risk was transferred in the event of decline in oil price. However, the issue arose when the company entered into future contract involving hundreds of millions of barrels. Despite the fact that the company expected to offset future losses with gains from forward contract, a cash flow crisis ensued due to a substantial margin call. Additionally, the adoption of Germany accounting standard contributed to the failure of the MGRM company. This is because the losses from future contract were immediately recorded, whereas the profit from forward contract were only recognized at a later date. In this case, Arthur Benson, a former president of MGRM company, was held responsible for the company's failure. This was primarily due to his strong belief that the oil price would continue to follow a backwardation trend without taking into consideration the possibility of market shifting to contango. While the German accounting standard and the contango trend were contributing factors, the main issues stemmed for the significant scale and size of the future contract entered into. Claims should also be chaired by MD Supervisory Board, as the approval of such projects fall under their jurisdiction. It is evident that the board lacked knowledge in derivative, leading to a misjudgment of the associated risks. In conclusion, MJ Company incurred a loss of approximately $1.3 billion. In order to mitigate this loss, the company sought a bailout from banks and also divested several divisions. Subsequently, in 1994, MJIM filed for bankruptcy and its parent company, MD, withdrew from the oil market in 1996. The downfall of the company should serve as a cautionary tale for the business, emphasizing the importance of comprehending the financial market position and the consequence of the market fluctuation. It is imperative to establish a comprehensive plan and strategy when making crucial decisions. Finally, it is well accepted that MGRM company engaged in hedging rather than speculating. The underlying intention was to safeguard the initial agreement, while the significant losses primarily stemmed from issues related to accounting management and cash flow, which were exacerbated by substantial margin call.